And you, Vecchio, I will remember, you did not side with me, okay? You think you have job security, but you don't think you know. You don't know what you know, okay?
Were we on the same side? We both pronounced it the same way.
No, he did not.
You and me.
Unbelievable. All right. Okay.
All right. Well, this lesson in linguistics aside, the market's wondering if this is going to be another Taco Tuesday. If you look to options pricing through the rest of July, you really haven't seen a significant movement on the other side of this. It's not like traders are thinking this is going to be a big deal. But it also brings up the paradoxical nature of the taco trade, right? It was back in April when Trump saw the bond market getting a little spooky, as it were, that he decided to reel things back in. With stocks at all-time highs, volatility sitting fairly low right now, having just passed this legislation, it seems like there's a lot of movement and availability to go to the downside here. So I question, because the market isn't responding to the news of the tariffs like we did in the past. Is this story dead for the markets here? Have we just completely moved past what Trump and co are saying, and we're just going to continue to ignore the noise here?
Yeah, because I think the markets... we've had this discussion the last couple of days, from Sunday night, yesterday, and again today. I think the market has deemed the whole tariff thing as originally it was about uncertainty. So the reason that you mentioned the term taco trade, or the reason you talk about things in uncertain terms, the market is able to deal with uncertainty as far as pricing goes. And at first, it had to learn about it, and then it, absorbs all the information, that it rationalizes it however it wants to, and then it prices things. I think the uncertainty has a long time ago turned to pure stupidity. Like, I really believe that it's not recognized anymore as something that is, it's not viable. It's just a stupid, PR tactic or marketing tactic, and so the market doesn't care. It really doesn't care anymore. So you can call it whatever you want. The market just doesn't care. It does not move markets anymore. Like a 25% tariff on Japan or 25% tariff on Laos, rhymes with house, doesn't matter anymore. It's not going to impact, none of this is going to impact markets, and the market's just going to do its own market thing.
Did I win $20 is all I want to know in this whole discussion?
I think the bigger issue for the market right now is what you mentioned, just kind of as a side note. I think that, at 112.27 or 112.25, where the bonds are right now, that any rate cut is off the table. I think it ties Powell's hands, pushes rate cuts back for a whole nother quarter if they stay at these levels, because I don't think you can lower rates when bonds are, a few ticks off their lows. So that's
we already know Powell's stupid. So he might do it anyway.
Powell is not stupid.
I'm just kidding.
The person that calls Powell stupid.
I'm just repeating what I heard.
Yeah, but Powell's not stupid. And so
repeating what I heard.
Just quoting the president, Tom.
Just quoting the president.
Quoting the president, right. But Powell's not stupid. And his hands are tied right here. So I think you have two issues. You have that will cap the market a little bit. One is bonds right here. I just think that really does put an upside cap on the market. And I think the other one is the dollar. And I think they kind of go hand in hand, but I'm not, they for sure haven't the last couple of days. So I think those are the two biggest issues those are the two biggest hurdles the market has to deal with right now. It's not tariffs.
Can we talk about the dollar for a quick second? That's actually one of the items I'd like to discuss here today.
Yeah.
A little birdie told me that it was something in your ear. Each week we have the CFTC COT report that comes out, positioning in the futures market.
Yeah.
This week it was delayed until yesterday because of the Independence Day holiday on Friday.
Okay.
But I ran the numbers on the latest positioning update for the euro and the yen. Right now, the net long position in the euro has a Z-score going back 20 years on a rolling basis. So the data set is July 2005 to present. The euro has a Z-score of 1.34. The yen still has a Z-score of 2.66. Okay, so yen positioning, net long yen positioning is still 2.66 standard deviations above its mean. These are very stretched markets right now. And
we agree with you.
Yeah,
we agree.
Yeah. There's an opportunity here right now. There's volatility in the yen, at least to me, is a little bit low. I've been buying yen puts for the better part of the last 2 weeks here, right around that 0068 figure.
I do not like it.
I know you don't like it, but let me explain, if you will. If you're looking at what's going on in the Japanese bond market right now, you're not seeing the situation typical of what's happening in the currency world, where yield differentials control the currency. Like with the British pound, you're starting to see how higher long end yields is actually hurting the yen, like it's hurting the British pound. And that's not dissimilar than what the dollar went through back in early April. So if you're entering a world where currencies aren't benefiting from higher yields and instead getting hurt by them, and they have extreme positioning on the table, they're prime candidates for a big reversion trade. And so the dollar has been beaten down. It's the worst start to the year in the dollar's history since Nixon took us off the gold standard in 1971. Stretch as stretch can be. And so if we're going to be playing, opportunities where everyone is on one side of the trade, I think right now, my point of view is you got to take these shots at long dollar positions, because if you're wrong, you're going to be wrong small. Everyone's already there. But if you're right, this thing could snap, and it can move very, very quickly as everyone shuffles out.
I could not agree more. I just think you're in the wrong. The only product that hasn't rallied is the yen. So why would you get short the yen? The yen's the same price as it's been when the dollar was 10% lower and the yen was the same price. Like, the yen hasn't moved at all. It's been trading in the 68 range the entire year. I know it got a little lower, I know it got a little higher, but 68 is like the mean for the year. It hasn't moved. Whereas the euro, it's just the euro, the pound, the Canadian dollar, they've all exploded. And this is a very different, those are very stretched markets, every single one of them. I like the long side.
They are stretched, just not as stretched as the yen by historical standards, for the record.
Yeah, I don't like
you're not going to find a Z-score north of 2 on any other currency right now.
I don't like that argument. I don't see it the same way. I really like the yen to the long side here, and I like all the other markets to the short side.
Well, I think it's long dollar either way. And, that ultimately brings up what's happening in some of the commodities. Gold, silver here, they've been taking a little bit of a hit today, but they've been resilient over the past week. I've been chopped up in gold the last few months just by leaning long and not ultimately seeing follow through to the upside. I'm curious, though, after seeing the gold-silver ratio jump above 100 and now it's sticking closer to 91, 90 in that neighborhood, do you think that there are traders to play a pairs trade within the precious metal space right now, as we think about this low volatility equities environment making our way through the middle of summer?
It's really amazing how much that spread does move around. We got shorted way too early, obviously, and it went all the way up to 102, 103, maybe even 104 at one point. Now it's back down to 91. It's really moved all over the place. It's such a hard trade to get in front of because it's such a big trade. It takes no prisoners along the way.
When you're wrong, yeah.
Yeah, when you're wrong. I don't think it's enough of extreme here for me to get in it. So if you're asking, would I buy gold here and sell silver? I don't think so. It's not interesting to me. We've been short strangles in gold, and we just covered them. No, the long dollar play, short euro, short everything else, I like that. But the gold silver ratio getting long at 91, I don't like that. The more interesting trade to me has all along been the bonds here. But I stopped buying them yesterday because I got nervous. I have a theory that I was going to talk about yesterday or today, but I'm going to hold off until tomorrow because I need to do a little bit more research because I have a crazy, creepy theory. And I don't want to bring it out until I can, till I feel more confident in talking about it. But there's something weird.
Creepy is an interesting adjective. I've never heard you use that word before to describe something.
There's something weird happening, which I don't.
Vocabulary.
Something weird happening, which I don't fully understand, and I'm just researching some stuff to see if it's even possible what I'm thinking. That's all. That's with the bonds.
Can I share a fun story with you guys?
Yeah, sure.
Because maybe, sometimes we talk about things that are happening in the industry or the financial world writ large. Maybe it's not trading related, but has to do with the business of trading. In recent days, the Securities and Exchange Board of India has issued an interim ban on Jane Street and its affiliates in India and Singapore because the firm has apparently been running a deliberate and systematic manipulation of the Bank Nifty index, India's stock market, via coordinated trades across cash, futures, and derivatives, according to the Financial Times. And so the SEBI is arguing that Jane Street on key expiry days, like specifically January 17th, 2024, they were placing these big purchases on the Bank Nifty equities and futures to inflate the index, while they were shorting positions in the index options, selling calls and buying puts, and they were unwinding and slamming the close every single day. So they've been banned. This obviously follows on with another different unrelated story that Jane Street apparently had been financing the purchases of AK-47s for rebels in South Sudan. Okay, but Jane Street has a different story here, Tom, and I think it's perhaps a defense that you would be partial to. According to Matt Levine over at Bloomberg, he says that this is not manipulation, this is arbitrage. Jane Street came in Friday morning and noticed that Indian retail traders were buying options on the Nifty Bank Index at much higher prices than where the index was actually trading. So Jane Street got to work doing what it does. It sold options to retail traders who wanted them and bought the underlying stock to hedge until the arbitrage closed. At the beginning of SEBI's window, the options were trading at a 1.6% premium to the underlying index. By the end of the day, that gap had closed. It's obviously very difficult for American traders to arbitrage here, but is this untoward to see a company, an HFT firm like this, doing this in a market that has thin liquidity and not as developed as its U.S. counterparts?
I have long, so it's almost impossible for U.S. firms to break into the Indian markets. And a bunch of our customers, we have a pretty big following in India. We have a big Indian customer base here in the U.S. So I talk to a lot of people specifically about this topic. I have long argued, besides the fact that the Indian markets are closed to outsiders, which they really are, it's almost impossible for U.S. firms to break into that marketplace. I don't even know how Jane Street got in there. But our experience with Jane Street is they're a very reputable, honest firm. Like, we've only had good experiences with them as a high frequency firm in the U.S. I have felt for a long time that the Indian markets, without having high frequency firms participate in their markets, is one of the reasons why their markets have a lot of volume on crappy little indexes, but no real, there's no real depth to their marketplace. They're not really tradable. They're very one-dimensional products. The Indian marketplace needs HFT market making in order to really grow their business. Jane Street was exactly what they needed. They need Jane Street. They need Citadel. They need every big market-making firm in the world to participate in the Indian markets, and then their markets will explode. Their regulators do not understand that, and their regulators do not understand index arbitrage, and their regulators don't understand scale, multi-product scale, basically just positioning. I have no doubt, and I've read a lot about this. Mm-hmm. I have no doubt that Jane Street took advantage of the inefficiencies of their market. And I also have no doubt that Jane Street did nothing other than trade kind of what was there. In other words, they just used the technology that drives U.S. markets in the Indian markets. That's all they have.
All right, so hold on a second. You mentioned it yesterday. You're talking bonds with Chris right now. You had this super secret bond idea that you
This has nothing to do with that.
Well, can you give me your super secret bond idea?
What does that have to do with this? We're talking about this.
I know, but can you give me what your super secret bond?
No, because we're talking about Jane Street right now in India. Because it's a really interesting case. Because this case, I'm glad you brought it up. Because this case is what's going to lead to the growth of trading all around the world. Because the problem in India, which has the closest thing to an SEC environment and is potentially closest to our markets, volume-wise and everything else, plus they have 1.6 billion people and everybody likes to manage their own money. India, to me, is the place that needs to blow up the whole financial space to go global. The problem is, and I've done a seminar there, 2 seminars there, and I've talked to the head of the exchange in the Bombay Stock Exchange, and lots of different brokers over there. They need efficient markets. They need people to be able to make markets in order for people to trade those markets. And this is the key to their growth. And they do not get it. And now they're kicking Jane Street out. So that, again, that goes back to a closed market environment, and they want to go backwards, not forwards. I think it's a huge mistake. And I think the regulators are making a huge mistake. And I think it's going to set the Indian marketplace way back. When they all figure this out, they're going to understand that the only way to grow is through efficiency, and you need market makers to do that. They do not have market makers. So I'm agreeing with the guy from Bloomberg, and I'm agreeing with what Jane Street said. And this is not, they didn't do something illegal. They just made markets, and they took advantage of arbitrage opportunities. There's nothing wrong with somebody wants to buy something, you sell it to them. And if you want to buy the underlying index, you buy it. It's only 50. In most cases, only 50 stocks there. It's a simple arb. They just don't.
Right, it's only 50 stocks.
Yeah, most of the indexes are on their Nifty 50, whatever. But so you just buy the index. But they only really have like daily and weekly options. There's not really any much monthly stuff trading. Mm-hmm. It's very, you can't spread anything. It's really limited what you can do there. So their pricing skew is all messed up because customers over there, you can't short anything. So all you can do is buy. So you got this crazy pricing skew on all the out of the money options. And all Jane Street did was just whack them all because they could buy the underlying stocks.
I mean, it was no different than what some of the companies were doing during the GME saga, right? Like, if people want to buy the deep out of the money options, happy to sell them to you.
Well, yeah, but the problem is that people in India have very small accounts, so nobody can afford to buy the underlying stocks or the futures. Mm-hmm. And you can't short. It's almost impossible to short something, and you can't do spreads. There's all these crazy rules. Like, you can do them, but they're just. You don't, one side doesn't offset the other side. There's just kind of the rules are a nightmare. You know, we've argued with regulators there for a long time. It's really hard. I'll just leave it there. You brought up a really good topic because in order for India, China, South Korea, in order for Europe to figure out like how to compete with the US, they need really strong market making firms that can step in and make markets. And it doesn't exist yet. Yeah, we've been following this case. It's very interesting.
So what's the bond trade, Tom?
You'll find out there's no trade. The trade is you got to be long bonds. The trade is you got to be long bonds, but you can't buy too many of them because I've got an ugly feeling about something, which I don't usually have.
That's the super secret thing that he won't tell me.
Yeah, because you're not the right
Tony,
person to have this debate with. What?
Oh.
I'm too stupid, is what he
No,
just
you're not
said.
too stupid. It's just that I want to have an
Intellectual debate?
I want to debate it, and I'm thinking about I need to do more research.
So he's going to have
5 down
Dylan
days in a row
explain
in the
tomorrow.
bonds. We don't see 5 down days.
You rarely see 5 down days in the
Right.
bonds.
Last time you saw that was back in April when they made lows.
Yep. I mean, they traded once. They're only down 116 to 113, basically.
They're about 9 or 10 ticks off their lows. This most recent move.
Yep. If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.